Here we go. Recording now. All right. So, all right. So I want to go over the calendar. I have taken a look at all your contracts, which are great. And your project milestone work in process is due on Friday night. So let's just look at the calendar really quick. So I'll go over there and find the calendar. Here we go. Okay, so we are here, Zoom office hours, and I should have had the exam listed there. I don't know why it wasn't. No, that is not what I want. Okay. All right. Our next exam is a week from tomorrow. Okay. So we will have it. So we're here, we're finishing up chapter 5, part 1 and part 2, and then we'll go into test review. Monday is a holiday, so I won't have any office hours on Monday. And then we'll meet again on Tuesday to do the last test review for the exam. Okay. All right. So then today, so Friday night, your chapter 5, part 2 homework is due. It's only about 4 questions, and it has to do with appendix 5A, which is in the back of chapter 5, and that's only a few pages. And then what I want here is your contract status. So the way that works is, if I can open it. The way that works is you just upload whatever you have done so far. So you have to do something. You can't not do something. And so we want to make sure that you, so I'll go through the speed grader and I'll give you feedback on whatever you submit. So don't do something like a one sentence. Show that you've completed some work. So if you're doing the spreadsheet, start in on the spreadsheets. If you're doing the description, if you're doing, so let me bring up the project really quick so we can talk to that. All right. Turn my phone off because all of a sudden people are sending messages. All right, so here's the project. You guys can see it? Yes, no?
Yes.
Thank you. Okay, so you've submitted your contracts, and some of you had deadlines beyond next Friday, but no matter what, you need to start and upload whatever you've done by then. So for example, title page and company backgrounds, horizontal analysis, the tables, the spreadsheets. You don't have to finish them, but you have to start them. Written trends, you may not get to that. Comparison of 2 companies, may not get to that yet. You can start it on that. So that's the first half. 4A, remember, is your financial statement analysis. The second part is your business model analysis, not financial. So the whole thing together is your company analysis, but they're due in 2 pieces. All right. So research and make notes for PowerPoints. What have you done so far? Research on the government score, research, more articles. And then if whoever's assigned the PowerPoint shall set up the PowerPoint, maybe start putting some graphics in there. So, I always recommend that students put like images of brands in there, and that helps with that as you're doing that. Now here, final review and upload PowerPoint and notes. Now remember, for the final paper, I'm sorry, for the final presentation, you guys will be doing a an oral presentation to the class, and we can either do it, you can either make arrangements to do it during my office hours and I can record it, or you can pre-record it and send it to me and I can share it with the class, and then the class will critique some of the presentations. So here we are here tonight. The project is due March 7th, so you've got some time. The final paper, that's the financial analysis. And then this is the business analysis. So they're really 2 separate things. So this is the only part that you're doing an oral presentation on. Okay, I just wanted to make that clear. And then you'll be doing some critiques of other presentations. So you'll go out and watch another presentation and you'll critique it. All right. All right. And then we're coming down to the end of the quarter here. So I don't want to get too far ahead of myself, but that's, so any questions on the projects? So, okay. All right, great.
I actually had one question.
Great, yeah, go ahead.
In my group, my responsibility is the written trends, and as you mentioned, maybe we won't get to that so soon. But would it be acceptable for this week's assignment to maybe write up exactly what ratios I plan to use for comparison in order to compare the income statement and the balance sheet, that sort of thing?
Aaron, is that all you're doing?
Yeah.
The written trends?
Yeah, I think for 4A, I think that and I'm auditing one of the others. I think I'm auditing the written comparison. So again, both of my assignments are written.
Are you doing anything for 4B?
For 4B, I'm doing the governance score.
So you could do that instead.
Okay, I can get started on that.
I wouldn't worry about your writing till you have the data.
Okay.
Because there's a lot of data and you may decide not to talk about it all. So
okay.
You've got horizontal trends where you're saying how are the sales looking over 3 years? But you also have ratios. And so some things are just stagnant and you're just going to have one sentence and say, this is how we're doing. And then I would go ahead and do governance scores because that's not,
Understood.
You're not dependent on somebody else. So
got it. Okay, well, I'll get started with that. Thanks.
Yeah, and just make sure you understand what they mean and then how the company's doing. And it's sad because we can't get historic governance scores, so you can't say if they're improving or not, but
oh, you can't see that.
I kind of wish they did, but so you just kind of have to look at them compared to the other company and say, because you're going to do it for both companies, you can say which one has better, you can write a little vignette. Now, I want to be clear that the paper is about the financial analysis. Down here, I want you to visualize the PowerPoint really like a presentation with talking notes. So your talking notes will be inside your PowerPoint or in a separate Word document, but it doesn't have to be this beautiful paper. It's just as if you were doing a presentation and you had your talking notes. It doesn't mean you have to read them, but it's just something that you can refer to. So yeah, good question. All right. Anybody else? Okay, let's come back here. All right. Okay, so test results. I have graded most of the exams. Everybody in the room, I think. The class average was really high. It was 83%, almost 83.5%. I obviously can't read your individual scores, which is why I'm setting aside some time at the end to go over that. But I kind of wanted to go through a little bit of the test with you. I don't really like posting the test out here on video, so I'm just going to kind of talk to it. So we had, let me just bring up the test for me to look at. So I'm not going to. All right, here we go. All right. So the tests were fairly parallel. So you guys had similar questions, different numbers. I thought overall you did fairly well on the journal entries. I thought that I could see that you understand some of the basic journal entries. There was a couple that got some of you, not all of you. Let's see if I can bring that up. So let me put this question in the chat and let's see. So something you want to be really cognizant of is just really, really, really reading the questions. So here's a chat question. All right, here you go. Oh, that was to the wrong person. Let's get it to everybody. Okay, can you guys see the question we had on the test in the chat? So take a look at that for a second, just give you time to read it. Okay, purchased land for a golf course, paid 10% cash and agreed to pay the balance in 6 months by signing a 6% annual rate. So if you guys could, oh, I didn't give you the dollar amount. Let's see, what was the dollar amount? I think, there you go. So if you guys in the chat could just direct message me the answer to that one. Go ahead and put your answer for that in the chat. So how would you make a journal entry for that? Oh, everybody's quiet. Do I have a lag? So okay. Okay, got one answer. Colby, you're correct. Kate, you're correct. Yeah. So in that question, purchase land for a golf course, paying 10% cash and agreed to pay the balance in 6 months, signing a note. So it's real important that when you say that we paid, so the first thing we hit is land for the full value. And now everything else is just how we paid for it. Okay, we debit land, we credit. Good, yeah, credit cash, 10%, which is going to be 10% of 180,000 in this case, which is 18,000. And then the balance is, oh no, Aaron, yeah, the balance, let's go back and look at the problem. It says, agree to pay the balance in 6 months by signing a 6% 1-year note.
Okay, I don't mark that quite yet then.
So it's going to be note payable for the balance. In this case, it's going to be 162,000. Oops. And now I'm direct messaging you, but here we go. Let me just.
Okay, yeah, I got it.
Okay. So debit land, 180. Credit cash for 10%, which would be 18,000, and credit notes payable. But you have the idea for 162. Okay, even though you haven't fully paid for the land, you get to put that asset on your books for the full 180,000. Okay, so that was one journal entry to go over. The other one, I'm going to write this one. I'm going to put this one in the chat if I can find it, and that is. Here we go. Okay, for 2 days. A down payment. Amazon, a customer, made a down payment for the rental of the course for 2 days in November. Okay. Today is July 20. Okay. Okay. So give me the answer to this one. Amazon, a customer, made a down payment for the rental of the course, that should say course, for 2 days in November. Today is July 20th. So the company is Cheyenne, the customer is Amazon, and they prepaid for something. So how does the company record that prepayment? Colby. Yes. Tara. What's the debit, Tara? Yes. Okay. Kate. Amazon prepaid, but we're doing the books for the golf course. So not Amazon's books. So the golf course got money. Yeah, Aaron, correct. Yeah. So the golf course, yeah. No, well, it's partly the other way around. Definitely debit cash. The golf course received the money from Amazon. Cash goes up, so we debit cash for 36. What's the credit? What do we give? Correct, Kate, you're right. Yeah, okay. It can be unearned revenue or unearned service revenue. So because it can't be rent revenue because it's in the future. So when a customer prepays for something, so am I correct that you have to prepay if you buy a Tesla car? Do you have to prepay for it or do you have to just put a down payment on it? I can't remember. I think you have to prepay the whole thing. I don't really know any Tesla people, but my understanding is you have to prepay. So the company, if the customer prepays, cash goes up, debit cash, and the company actually owes you, in this case, the rental of the golf course. And when companies owe something, that's a liability. That's going to be, and it's not going to be revenue. It won't be revenue until the service has been provided. Okay. So those two were probably the big ones. There was one other one. Let me put this one in the chat. The company rented out the golf course to a customer, of course. The customer paid 1/3 in cash, the balance in 30 days. Okay. So again, we're doing the company's books. So a customer came and rented out the golf course, must have been the whole golf course for 21,000. They paid 1/3 in cash and the rest they're going to pay in 30 days. So if you're sitting here thinking, I can't think right now, start with cash. What happened to cash? Did cash go up or down? Oh, Leanne, you caught that. Yes. Okay. Tara. Let's see. Kate, you're correct. Do you have dollar amounts in there? Okay. Yeah, that's correct, Aaron. And if you put service revenue instead of rent revenue, that's fine too. Kate, that's correct for cash. All right. That's correct, Kate. Yeah. Debit cash, debit accounts receivable. So cash is 1/3, accounts receivable is 2/3, and they get the whole rent revenue. So that's kind of a new concept for most of us when we learn accounting 201. You get to record the whole revenue. Why? There was an exchange. What was the exchange? The company rented out the golf course for $21,000. The company provided the golf course. The customer committed to paying. They partly paid for $7,000. They promised to pay the balance. That's an exchange. Okay, and that's a new concept. I mean, you still have to kind of wrap your brain around what's the service provided. Okay, so other questions. So the other question that we want to talk about on the exam was the statements. Overall, you guys did well on the statements. Let me just put up the blank forms here so you can see it. So the challenge here on these statements was that, can you guys see this? Just pulling this off. The challenge on the statements is getting a trial balance, which, by the way, because this was not a scrambled trial balance, it was kind of nice. It was in the right order for you for the statements. Okay, so when you get a trial balance, that's like a huge, Kate, no, it doesn't matter if you put rent revenue or service revenue. So, so here's your current assets. Here's there wasn't any long-term, here's land, I'm sorry, here's your current asset, here's your long-term investments, here's your property, plant, and equipment, here's your current liabilities, long-term liabilities, common stock retained earnings, and then dividends, of course, is only on the retained earnings statement, and then there's your income statement accounts, okay? So the places where you guys lost points, I think almost 90% of the class got the income statement, so that was awesome. And most of you got statement of retained earnings. Okay, where you got in trouble, some of you was in the classified balance sheet. I gave a lot of partial credit on the classified balance sheet, so that's great. But things were like long-term investments were missing. If we look at the Franklin balance sheet, if I go out to that, it's really super helpful on what does a classified balance sheet look like. And I actually use it myself, and when I'm teaching or preparing a test, just to make sure I've got all the categories right. Although by now I've pretty much memorized it. This is it right here, okay? So current assets, then long-term, then property, plant, and equipment, if there's intangibles, then current liabilities, long-term liabilities, and stockholders' equity. There was an area where you guys, there was some confusion, and it showed up on a homework problem as well. And that was what to do with this account. Long-term note payable due in 1 year. That's going to be a current liability. Okay, but overall, you guys did really well on that piece of the problem. Okay, all right. And let me go back to next ones. Account identification, you know, whether it's current asset, long-term, you guys got most of that. I think the average on that question was, that was like this guy. I think it was like 80% that you guys, so you're doing the account identification drills. Okay.
Wait, I have a quick question. So you said the note payable due in 1 year, that would be a current liability?
That's correct, Kate.
Oh, okay.
Yeah, and I think that was on one of your homework problems. So a current asset is an asset that's going to be used up in 1 year or sooner. A current liability is a liability that needs to be paid or service provided within 1 year or sooner. Let's see, what else was on this? Oh, correcting the trial balance. Most of you did really well on that. And then the essay, I thought you guys did pretty well on that as well. The one kind of area of feedback that I give you guys on the essay is make sure you use, when you talk about net changes, make sure you talk about the dollar net change and the percent net change. And when you give me a percent, give me 2 decimals to support it. Okay. And then the current ratio, I gave you the formula here. I think you all got that right. And then again, you know, give us your, give me your rationale. So, all right. Okay, so I'm happy to meet with you guys. Let's start that at maybe 5:15, 5:20, and I will stay a little bit later tonight to get to everyone that wants to talk and go over their test results. Okay. All right. So let me switch gears to chapter 5. So you have chapter 5 homework due tomorrow, part 1. I can move this over. So this is the first chapter that we're doing. Okay, can you guys see it? Yes, no?
Yes.
Great.
Yes.
Okay. This is the first, thank you. This is the first time we've had companies that have a product, and we, in Accounting 201, we have companies that have a product that are just retail companies. They're buying for retail, for resale, I should say resale companies. They're not doing any sort of manufacturing to the product, okay? In Accounting 202, we don't deal with products at all. We just deal more with the balance sheet and analyzing the balance sheet. And then in Accounting 203, management accounting, we'll get back into companies that actually build products and add value to it. But for right now, these are companies that just buy something and resell it. Maybe they buy in bulk, in large quantities where they can get volume discounts, and then they resell it. Okay, so lots of different companies. And what I want to tell you about chapter 4, by the way, the adjusting journal entries and closing journal entries, is this exam is heavy on journal entries. So again, I always tell students, get yourself some flashcards. In chapter 4, there's 7 adjusting journal entries. There's variations, so it might be prepaid insurance or it might be prepaid rent, but the mechanics are about the same. Make flashcards, put the prompt on one side, the journal entry on the other, so you're real familiar with the journal entries. 7 adjusting journal entries, chapter 4, 4 closing journal entries, chapter 4. Okay, now we move over to chapter 5, and the main part of the chapter has purchasing transactions and selling transactions. So when you do your homework and when you take your test next week, you always want to stop at the beginning of the problem and say, are they purchasing? That's one set of journal entries, and that's going to involve accounts payable. Or are they selling product? That's another set of transactions, and that's going to involve accounts receivable. So accounts payable is when a company buys something. Accounts receivable is when a company sells something. Okay. And we have a new account this chapter called sales, and sales is used for when we sell product. Up till now, we've called it service revenue, or more specifically, rent revenue, but you can always use service revenue. That covers everything that's not a product. So service revenue versus sales revenue, which is when there's a product. And now we have to track the cost of the goods sold. So we have 2 more new accounts, inventory and cost of goods sold. Okay. And yes, that's an account title. You can abbreviate it as COGS. It's a really goofy account title because it's 4 words, but nobody does that. They say COGS. Now, if you look on financial statements, sometimes they rename that cost of sales. It means the same thing. Okay. All right. So here's a service company, service revenue, expenses, income before tax, income tax. Pretty straightforward. Here's a merchandise company where we have sales, cost of goods sold. Those are 2 separate accounts. Cost of goods sold is a very specific expense account that we subtract from sales to get gross margin. Okay. Then we list all the operating expenses, subtract that from gross margin. Then we get net income before tax, income tax, net income after tax. Okay. So everything in red here is a calculation. Everything in black is an account, or in the case of operating expenses, it's a list of accounts. Service companies don't have goods. That's another name for inventory, goods. So they don't have cost of goods sold or gross margin. Okay. All right, when a company buys inventory, they debit inventory and they credit cash or accounts payable. And the expectation is they're not going to hang on to it for a long time. They're going to buy it and resell it because you don't want it sitting around in your shelves. So next time you go to the grocery store or to Target and you see all that inventory in the room, in the store, think of it as money sitting on a shelf. The company has paid money for that inventory so that you and I can walk through the store and figure out what we want to buy. Some of us have gotten tired of that, and so we buy online. Some of us like to stroll through a store and see different products. But as long as we have stores and we're walking through the stores, that inventory is sitting there, and it's a company who has spent money on something, which is cash going out, and they're waiting for customers to come along and buy it. And all the cost that's necessary to get the asset ready for its intended purpose. Okay. So there's lots of different components to getting a product into the store. You have the original invoice price of the line item, the product, but you also have to ship it from the manufacturer to the store. So that's freight in. And it's possible that if a company buys a lot of product from that same manufacturer, they'll give them a discount, which would reduce the cost of the inventory. And it's also possible that when the inventory arrives at the store, that there might be some damage, or that the company says, no, I don't like this shade of blue. It doesn't look like the picture, and they return it, and that'll reduce the cost. Okay, so there are 7 transactions for perpetual inventory system, purchases and sales. And there's another 7 transactions for periodic. Periodic is in the back of chapter 5. Okay. What you need to know is how to do all those 14 journal entries. And you also need to be able to build a multi-step income statement. So first we learned how to do the classified balance sheet. Sorry, the basic balance sheet in chapter 1. Then we went to chapter 2 and we built the classified balance sheet. But we still had the same income statement. Well, now with chapter 5, we're switching to the multi-step income statement. And I want you to learn how to do it for perpetual. And then in the appendix, I want you to learn how to calculate cost of goods sold. So they're basically 2 different methods of tracking inventory. Perpetual is more common now. It didn't used to be. But the periodic is used for certain types of businesses. So. All right, so I want to go through the whole summary, the side-by-side comparison here. I don't want to go through all my slides because you can watch them. But there's a whole bunch of sales transactions and purchase transactions. And I'm going to slide ahead to this side-by-side comparison. Here we go. So I can do that. And all right, in my PowerPoint slides, you can see purchase transactions, perpetual compared to periodic, but perpetual comes first. So I talked about the basic invoice price, the freight costs, and that is freight in, the returns, and then your purchase discounts. Okay, so you buy inventory on credit, debit inventory, credit accounts payable. You pay the freight costs. Instead of charging freight for perpetual, we charge it to inventory. It's all the costs it takes to get the product ready for its intended use. So freight, you can't sell product unless you can ship it. Okay. If the company returns inventory, this is the reverse of entry number 1. You debit accounts payable and credit merchandise inventory. And then finally, when we pay the bill, you can see the number went down for accounts payable because it was the original 1,400 minus the return, and that's what we owe. However, in the example in the PowerPoint, the supplier gave the company a 2% discount, or I think that's a 2% discount. So again, that reduces the cost of the inventory. So the inventory, if you take all these transactions, 1,400 debit plus 140 debit minus 130 credit minus 25 credit, okay? And then again, for the sales transactions, this entry should look pretty familiar to you when we make a sale on credit. We sold to a customer, debit accounts receivable. Instead of service revenue, it's going to be sales because it's a product. But now we add this second set of journal entries. The problem has to tell you what cost is. We debit cost of goods sold and we credit inventory. So what's happening with this second journal entry here is we're saying we have to take the inventory out off the balance sheet. It's sold. It's not part of, we couldn't go out and count it. It has been sold. And by debiting cost of goods sold, we're putting it on the income statement. Okay. If you have a return, we use a new account, sales returns and allowances, credit accounts receivable, and we reverse this side of the entry, debit inventory and credit cost of goods sold. Oops. And finally, when the customer pays, they collect the money. We recognize the sales discount and we credit accounts receivable. So you can see how this purchase and sales journal entries are mirror images of each other. Okay. I'm not going to talk about periodic because you will need to watch that video, but it's a lot simpler. The periodic journal entries are a lot simpler. Okay. Okay. So now I want to go, let's see. I can take us back to the multi-step income statement real quick. I just want to go through that. All right, let's look at that. Okay. So multi-step income statement. This is a single step income statement. Single step would be we bunch all the revenue at the top, and then we bunch all the expenses at the middle, and we subtract the total revenue from the total expenses, and we get income before tax minus the tax expense is net income. And again, in my PowerPoints, the pink highlighted are calculations. All the rest are accounts. Okay. See if we can go back here. But now we want the multi-step income statement. So the multi-step income statement has the word step means that we have subtotals. Okay. So here we have sales revenue, and we book all of these sales accounts together. Okay. So sales is our new sales account, but sales returns and allowances and sales discounts are also lumped together under revenue. Sales has a credit balance, sales returns and allowances and sales discounts have a debit balance. They're a contra revenue account, so we subtract them. So a lot of the companies I've worked for don't have a lot of returns. However, when I worked for Gottschalk's, which was a retail department store, returns were a big deal, and we used to track it by which stores had more returns. Was it bad management or was it a bad product? And we tried to stay on top of that. So that's the first step in the multi-step is net sales. From there, we make one more subtraction. We show cost of goods sold and we subtract it to calculate gross margin, also called gross profit. It's really important that we know what gross profit is. It's a very simple number and it's easy to compare one company with another company with another company. So, and as we go on the income statement, I'll tell you why. So if for some of your companies you don't have gross profit, call me up or do a quick drop in my office hours and I'll show you how to calculate it. Okay, now we list all the operating expenses. Okay, all right, and then we have income from operations. That's another, so total operating income from operations is another really important subtotal. What it says is, this is the basic business of the company. They're making 237,000 in sales, and they're getting operating income of 20,000. Operating income is what a company can create using buying and selling its own products, okay, as opposed to the things that come below. Okay, so let me take us a little further. So how well is Starbucks? So operating income would be how well is Starbucks at selling coffee and coffee products? How well does Packard do selling trucks? Now we've got to subtract or add other income or other expenses. Okay, so here are 4 new accounts that are defined as other income, other revenue, or other expenses. Interest revenue, anything with the word gain on it, gain on sale of equipment, they would be added. Other expenses, always interest expense or interest revenue. And the loss, whenever you see a loss there. So these are unusual items. A company's not in the business of borrowing money. Let me rephrase that. The company's core business doesn't involve borrowing money or loaning money unless you're a bank. Okay. Of course, a company has to borrow money, but that's part of your financing. Okay. This is operations. So remember, we started the class out. Companies do 3 things: operations, investing, and financing. And so the financing comes after operations. Okay. So that 20,278, we add the other revenue, we subtract the other income, and we come down to 20,978. Minus the taxes, get you here. So you could do this as a single step, but the multi-step gives us really rich information on gross margin, income from operations, and that really helps us contrast and compare similar companies. Okay, so I wanted to get through to that. The only other major calculation for periodic is calculating cost of goods sold. So make sure you understand how to do this. And that's using only the periodic accounts. With perpetual, you get to know cost of goods sold immediately. All right. All right. So I think you've got plenty of time. You got a whole week and a day to prepare for the next exam. And be sure to come to the review session next week as well. So, and then what I wanted to do now was make a list and go into the breakout room with you and go over your results. Okay, so let's see. I'm going to start at the bottom. Tara, you will be first. Tara, I keep wanting to say Tara. Sorry about that. And Maggie Nguyen, second. And Leanne, third. Leanne, where are you? Oh, Tran, okay. And Kate Larson, 4.